This concept video is number 2 in week 2. Now that we've analyzed business transactions, we're going to introduce how we use debits and credits in order to analyze and summarize and record business transactions. So our learning objectives here: 1, we introduce the idea of an account as a basic classifying unit for storing accounting information. And 2, we're now going to take those business transactions that we analyzed in the previous video and analyze them again in terms of debits and credits to these different types of accounts. To begin with, an account is part of this accounting system that we use to not only summarize but classify increases and decreases and come up with a balance for each asset, liability, revenue, and expense account, and so on. Now, firms set up these accounts for each business element, such as cash, accounts receivable, accounts payable, common stock, revenue, expenses. Every business has a cash account in its accounting system because they need to know exactly how much cash they have on hand. Now, to illustrate the recording of increases and decreases in an account, we must visualize what's called the T account. It looks like the letter T. At the top is the name of the account, cash for example. The T has a left-hand side and a right-hand side. So we record increases on one side of the account and decreases on the other. Now, back to the language of accounting. Keep in mind, this accounting language was developed in 14th century Venice. And the term for left side is debit. And the term for right side is credit. We abbreviate this by DR and CR. DR means left side, CR means right side. Thus, all accounts have a debit entry is on the left side, the credit entry is on the right. And when we recognize a business transaction, we analyze it to determine the increases and decreases that transaction has on the assets, liabilities, or revenue and expense accounts of the business. We translate these increases and decreases. We don't talk about increases or decreases. We don't talk about pluses or minuses. We simply talk about debits and credits. Now, each transaction that we record, the total dollar amount of debits must equal the total dollar amount of credits. Each transaction is recorded by an entry such that equal debits and equal credits, and this is called the double entry accounting system, and this ensures that the accounting equation remains in balance. Now, this might be easier if you focus on the equal sign in the accounting equation. Okay? You notice that assets are on the left-hand side of that equal sign, liabilities and shareholders' equity on the right-hand side. Okay, so you know that the left side of an account is called a debit and the right side is the credit. So what we have here then, because assets are on the left-hand side, we're going to record increases in an asset as a debit. And because liabilities and shareholders' equity are on the right-hand side, we're going to record increases in liability and in shareholders' equity as a credit. Now, the opposite, a decrease, of course, if we're talking an asset, will be a credit, and a decrease, if we're talking a liability, will be a debit. So to summarize, assets increase. It's where we record the transaction. If we record it on the left side of the asset, that means it's an increase to the asset. If we record it on the right side, that means it's a decrease. The opposite is true with liability shareholders' equity. That is, we record any increases in liability accounts on the right-hand side and shareholders' equity accounts on the right-hand side, and any decreases on the left-hand side. Now let's apply these rules to these accounts. Let's assume we have a transaction where the corporation issues shares of common stock for $10,000. Okay? Two accounts are affected, as we analyzed before, cash and common stock. Cash increases, so we record the increase over here. Common stock also increases, and it is on the right-hand side of the equal sign, so it will increase on the right-hand side of that account. Therefore, this transaction increases the cash and also increases the common stock. Let's assume second transaction, the company borrowed $5,000 from the bank by issuing a notes payable. That is, they promised to pay the bank back $5,000 at a specific time with interest. Again, two accounts are affected, cash and notes payable. If you visualize cash as a T account, well then we would record the increase in cash, because cash did go up, by a debit of $5,000. And we didn't have any liability before, but now we do. And so our liability increases, and that is recorded by a credit. Okay, so it increases on the right-hand side. Now those last two transactions were balance sheet transactions. Now let's look at transactions that affect the income statement, like revenue and expenses. Now because revenue increases shareholders' wealth, any increases in revenue will be recorded on the right-hand side because it increases shareholders' equity. Now you won't have any transactions that will decrease revenue. So any transaction where the company earns revenue, you record the increase in revenue as a credit. Now, because expenses decrease shareholders' equity, we are going to record any increases in expenses on the debit side. Now, there would be no transactions that decrease expenses. Expenses, as you know, only increase. If the company pays dividends, that too reduces the retained earnings or shareholders' equity section, and therefore, because it's a reduction of a shareholders' equity account, it is recorded on the left-hand or debit side. Again, to illustrate, let's assume that the company received $1,000 in cash for services rendered. Now, when they render service, that means they provided service to their customer. Two accounts are affected. And if you visualize each account as a T account, then the cash account was increased and the revenue account was increased. And the way we record that is simply a debit to cash and a credit to revenue. And that's it. That means an increase in cash and an increase in revenue. Now let's assume we paid salaries to our employees. Two accounts again, cash, because we paid cash, and salary expense. Well, cash goes down, so we record that on the right-hand side, or credit. And expenses go up, and always debit the expense. Lastly, if we paid dividends, well, we would have paid cash, so our cash would have went down, credit $2,000, and dividends went up, debit $2,000. You will notice, in each case, equal debits and equal credits. Now to determine the final balance, you simply add up. Let's say we had a cash account here, and we had so many debits and so many credits. Well, we add them up and we would record the sum. The debits exceed the credits, we would record the sum over here. If it was a liability account, let's see, accounts payable, it would have more credits than debits. It would probably increase more, and therefore, because it's a liability account, it would have a credit balance. So that's your introduction to debits and credits. You must practice this, and we will do problems where we practice this.